Hi, I'm Ethan Devitt, and welcome to this week's Markets Happy Hour podcast. It's Thursday, February 6th. We are coming to you with our traditional format today. And given the deluge of news that we've experienced in the last week, I thought it would be good to revisit some of the themes we've discussed over the last few weeks and look at where we stand now as we get into the shortest month after what has, as I mentioned last week, seemed like a very long month of January indeed. As usual, I'm going to share the slides, and I've entitled this week Spend, 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 as spending money, whether at the consumer level or at the corporate level, certainly seems to be top of mind and to be the key distinguishing feature of the US economy at the moment, as opposed to other economies around the world, which we've mentioned for some time. As usual, we're going to cycle through the five main points, starting with inflation, moving to interest rates, looking at equity markets. Again, all this against the backdrop of geopolitics. And we're also going to be including some other asset classes today, looking at why private markets arguably are even more attractive today, given the volatility that is increasingly injecting itself into public markets. When we're discussing the geopolitical and domestic political backdrop, we're going to talk about the factor of surprise. There have been many telegraphed changes, and certainly a lot of the policies being enacted in this flurry of the first few weeks of the new administration were well forecast and telegraphed. However, the on the ground implementation have proven to be somewhat surprising and maybe alarming at their speed. There have, of course, been other policies which are totally at variance with some of the policies that were described in the run up to the election. And these have given markets some pause, as there's a sense that this was perhaps unexpected, not discounted in, and now there needs to be a war room of sorts in terms of grappling with how, for example, stunning sharp tariffs on Canada and Mexico would actually work out when worked through a corporate model. The spending, as I noted before, is something that we will be returning to in terms of what this means for corporate outlooks and earnings. And then when it comes to financial regulation, we'll return to a little bit of the theme that we discussed in our live podcast last week, looking at some of the unintended consequences of regulation, but also focusing on the new stress tests that the Fed is likely to put in place around financial institutions. When it comes to inflation, we haven't seen any particular numbers come in the US this week, but we have seen out of Europe some signs that inflation is not exactly subdued. We've seen quite a bit of divergence throughout the Eurozone in terms of inflation, and still it is pretty much north of 2%, still in excess of the target. However, it seems that that's not likely to subdue the impetus towards rate cuts in Europe. We know that weaker growth is certainly part of the reality in Europe, and that's likely to feed into greater rate cuts. A similar picture in England, in the UK, where stagflation has been rearing its head. It does seem to be one of the few zones where stagflation, the combination of slow economic growth and higher than normal inflation, seems to be persisting. We've seen the Bank of England cut rates again. They were for some time quite a bit higher than they have been in other domestic developed markets. However, the really notable thing about the Bank of England report today was halving of its growth forecast to now below 1%. So very subdued, anemic rate of growth being forecast for the UK. It only underscores the urgency behind Rachel Reeves' desire to inject more investment and encourage more investment in the UK by its incumbent institutions, but very much subdued economic growth forecast. And that, of course, is somewhat depressing for the outlook for the UK at the moment. If we look across the interest rate spectrum, we can see that the UK before the recent cut was at 4.75. It's now at 4.5. You can see that it was already somewhat higher than other developed markets before this recent cut. If we look across the board, the US now is relatively high, having stopped at around the 4% level. And we can see that in Europe, we are now heading quite a bit south of 3%. So the differential between the Eurozone and the US in interest rate levels is still quite notable. And that, of course, is going to translate into a persistently stronger dollar, just as the UK has now cut its rates again. Again, bad news again for sterling, likely to be persistently weaker, again, when paired too with the more fragile economic reality on the ground in the UK. So across the board, Canada also cut rates. We noted that last week. So quite a bit of divergence starting to emerge among central banks. And we need to translate that into the currency implications, but also what signal that's sending in terms of the economic growth, the relative robustness of the different zones, and the relative performance that's likely to flow from that. If you were to continue reading between the lines, it's important to look at some of the rhetoric that we've seen coming out of these central banks, notably in the UK and the US. We know that in the US, the central banks have not been ignorant of the backdrop, and they are certainly worried about some of the uncertainty, which we'll discuss later, being sown with respect to tariffs. When it comes to the UK, the Bank of England, it says it's entering a particularly difficult phase because it is trying to thread that needle. They know that inflation is not subdued in the UK. It could even rear its head to around 3.5% still. But they also know that they desperately need to stimulate economic growth. And as we noted last week, we are still by no means secure from the idea that the transmission rate of interest rates is going to have the desired effect. And just as we had a breakdown between higher rates and contraction of consumer demand, we're also likely to have a bit of a breakdown between lower rates and stimulating the demand and offsetting potential economic slowdown. I don't think central banks at this point are assured that what they're doing it will have the effect that they previously would have had. So that does put them in a slightly perilous position. We also noted last week that it was important for bond markets not necessarily to pay attention to the Fed, to what they were saying, but equally to what the executive branch, what the president was saying, as that did seem to have some effect on the movement of bond yields. We'll talk a little bit more about that in a minute when we speak about the geopolitical changes and the massive reach we're seeing right now of the US administration. The final note we've said is that the Fed, clearly departing from other central banks around the world, is in no hurry to make any changes to its rates. That has their expectations have certainly come in terms of interest rate cuts throughout 2025, but the Fed is now charting its own course, which is quite different from central banks around the world. Moving now to equity markets. Equity markets have had quite a change of fortune this week. We'll now address the point of tariffs. So at the weekend, we of course heard that President Trump was intending to impose 25% tariffs on Canada and Mexico, as well as 10% tariffs on China. There was quite a firm rhetoric behind these tariffs. There was not at that point deemed to be anything that those neighboring countries could do to change his view around tariffs. And markets took this extremely severely initially. There was a flurry of commentators organizing update calls, reflection calls, and certainly it seemed that the unexpected had in fact happened, that the worst case scenario in terms of tariffs had come to pass. So this, of course, did spark a lot of reflection and soul searching on the part of corporate participants. In some cases, during the actual commentator or strategist call, we did see a reversal of the Trump administration's position. We saw initially a stay of execution on Mexico for 30 days, and then the very same period, the stay of execution agreed with Canada. So we now have essentially very little change. We have some gestures and some promises made around stemming the flow of fentanyl over the border, but ultimately not much is changing in terms of addressing the balance. What we did see, though, in the last few days and hours of when it looked like tariffs were inevitable, was a lot of analysis of the actual effect that this would have. It seemed that there was not as much knowledge as we previously thought about the amount of goods that flow into the US from Canada, such as oil, lumber, essential goods, components in the parts of cars. There was already a forecast of massive increases in some of these areas directly relating to tariffs. So we've already seen quite instantly who would be paying the price of this change around tariffs. So I would also imagine that this is now something that's getting a lot more scrutiny. We've heard last week about war rooms being put in place around Deepseek. I would suggest now that war rooms are going to be put in place around where and when tariffs can have an impact. And perhaps will the trading partners now look to alternate markets to send their goods? We saw the ECB just this week stating a fear that Europe could be bearing the brunt of the tariff trade war between the US and China, as China would find an alternative market for its goods, essentially dumping cheap goods on European markets, which would bring even more woes for European manufacturers already on the back foot. So these are perhaps some of the unintended consequences of the trade war. We know that given the interconnectedness of the world trade system, it's likely to be quite a bit of effect perhaps that we have not anticipated. So as far as this was certainly the impact on equity markets at the beginning of the week. We initially saw an equity market swoon, but not perhaps by as much as might have been expected. This was a little bit of a surprising show of resilience from equity markets. And then when there was the reversal, we saw that quick rebound again. So ultimately, markets have been unsettled, but not dramatically moving this week. We have seen, however, certain stocks being punished for showing disappointing revenues and for not meeting expectations. We saw in Google's case, Alphabet, that their revenue growth had slowed. We knew it was going to be boosting spending on data centers and capital expenditures to 75 billion over the course of 25. These are massive increases that we're seeing in capex spending coming out of not only the big tech companies, but many of the adjacent sectors there too. So we know that spending and on capex is going to be the new reality as we look to see how AI is embedded in many of these business models. And we can also see comments around the import of AI, and this came from Pichai from Google, where he discussed that the cost of AI would keep coming down. Clearly, that would expand this type of extraordinary use cases. A lot of excitement around AI, but clearly a lot of spending needed. And this all comes in the context of the news last week that Deepseek was going to be achieving many of the same results with a lot less spending. So we still are a little bit unsure, perhaps, as to whether the spending was based prior to the Deepseek news, whether the spending is in fact inevitable or could perhaps be open to change. But markets not in the mood to reward any disappointment whatsoever. And we could also see that the extent of the adjacent sectors, such as energy, how that was affected by the Deepseek news last week. So quite a bit of ripple effect and overall more volatility entering into equity markets. Just to underscore the extent of spending on capital spending on AI and other technology, data centers, etc., this chart I found quite interesting in terms of just comparing Alphabet, Amazon, Microsoft, and Meta, their expenditures over the course of 2022, 23, 24, and 25. We can see that mustard line for 2025 massively, clearly an outlier and massively exceeding expenditures of previous years. So we are in a position where spending is now the new reality, and perhaps it's only going to reinforce the moats that many of these large tech companies can build around each other. But this may be the assumption that, of course, Deepseek could lead us to undermine. So clearly, quite a bit of focus on this. And then when it comes to comparing some of these tech titans to their non-US counterparts, will the non-US counterparts have the cash on hand, have the resources to take advantage of this type of spending? We have heard the term arms race before being used in connection with spending on AI. So clearly this has become a very real arms race as we move now to the next advancement around that. Let's move now to geopolitics. We have talked about tariffs, and right now that news seems to have faded into the background. Instead, we are preoccupied in certainly the US media around some of the rather surprising unknown unknowns, in some case imperialist tendencies that seem to be flowing out of the current administration. We've heard already about claims of the Panama Canal, a desire to annex Greenland, Canada being the 51st state. And the latest was a plan for the US to take over Gaza, which seems to have come a little bit from left field or blindsided many foreign affairs commentators. And certainly the ripple effects of that are being felt in the neighboring nations. But even still, within 24 hours of this statement being made, we already had the press secretary suggest that this should not be taken literally. It was intended perhaps as a gamesmanship, or perhaps as a statement that might be designed to provoke a reaction among the Middle East counterparts. So quite a surprising piece of geopolitical news there. Again, simply stating an intention, no actual force or plan behind it. But again, a reminder perhaps of what we should be leading to expect in the current administration, where we've already heard about Doge and its running through the US agencies. We've seen USAID suggesting that would be closed down, lots of revelation of spending freezes and firings among federal workers. So at this point, dramatic amounts of change, a torrent of change coming in certainly the first 30 days of this administration. And these latest geopolitical pronouncements may just fall into the category of noise. Markets have not been reacting, but I will say what it is contributing to is a sense of much less resilience at this time among many of the companies and the markets, even though they have withstood so far some of this dramatic movement in expectations. Whether that resilience will in fact persist, that is the question. And the final question around this resilience is, what is this likely to mean for corporate investment going forward? It does seem that many corporate leaders were blindsided by the tariff news, and certainly they must have been blindsided by some of the geopolitical news. So the question is whether, not only on the back of the Deepseek news around spending, and now the suggestion that they need to perhaps game out a tariff or trade war environment, does that enable corporates to make investment with certainty? We seem to assume, based on the chart shown earlier, that spending is now a new normal. If corporate investment now needs to be perhaps embedded with a degree of probability, and whether certain outcomes or decision trees are likely to transpire, does that mean that corporate investment can continue? So a bit of a reminder this week that some of the resilience is in fact being tested. Last week, we had a presentation from a professor at WashU. She came, we had a live in-person conversation where she spoke about some of the unintended consequences of previous regulation, which did in fact lead to many of the factors behind the '08 crisis. In the current situation around regulation, we have new stress tests being put in place for the banks. It's interesting just to look at some of the tests that the banks are being put under as an indication of just what could be perhaps out there in a bear case for the economy. Unemployment jumping by 5.9% to 10%. That being one stress test. We've had nothing close to that up to now. Very much inflation hovering in the low fours. A home price decline of 33%. So a shock, certainly along the lines of what we saw in '08, '09. Commercial real estate declining 30%. That could arguably be a little conservative. If we've seen some office space, particularly B-grade office space, really lose value and essentially a holding back the keys situation, a decline of 30%, whereas on average it might be reasonable within certain portfolios and may even be conservative. So maybe that stress test isn't as relevant as it might be, and then also counterparty risk as a failure. So these are the new stress tests that the US banks will be put under. And I would say that for now, we can rest assured that based on a realigning of many of their desire to lend and their lending limits, etc., we have still quite a lot of assurance as to the robustness of the financial sector. To make one comment about climate risk, because in the background to all of these changes with the new US administration, we have seen DEI initiatives being generally put on the back burner or abandoned completely. We haven't seen a lot about climate change and initiatives, although we do know that the US has pulled back out of many of these alliances, and certainly that would be a repeat of many of the actions taken during the first Trump administration. We know there is not necessarily a friendly ear towards many of these strategies. And in some cases, there's actually been lawsuits and investigations about the fiduciary nature of pursuing mandates for which ESG or climate resilience is at the core. So I would say, where do we stand at this stage? I'd say the divergence now between the different asset management landscapes could not be more pronounced. We've spoken before about the divergence in terms of the economic growth across the US and Europe. But if we look at the divergence across the asset management landscape, between Europe, where climate risk is very much at the core and responsible investment policies are becoming a new normal with institutional investors, that there has been a chilling effect for many of the European asset managers for whom this has now become part of their DNA. They have realigned their businesses, they have hired staff, they have incorporated these values into many of their mission statements. And now we see that this is not a welcome mission statement on the other side of the Atlantic. So it's interesting to read that investors are now tiptoeing around some of these areas, which only a short while ago would have been very much front and center of their pitch. And it's interesting if we think about how engagement is also changing. It's suggested here from Elgin, which is one of the leading passive managers and certainly would be leading much corporate engagement, out of the UK and their global presence, that engagement with companies has become harder edged, suggesting it has become perhaps more aligned with commercial reality, that there is not perhaps this principled approach to climate action. There is a desire to make it aligned with the corporate's own fiduciary duty to its own shareholders and to ensure that this is compatible with having a sustainable business. So I think we are seeing the change in the shape not only of the language, but also of the intent and purpose of some of these actions. And that has become something that we will watch over the next few months and years as we see just how some of these positioning between European and US asset managers, as well as those around the rest of the world, start to change as they have to refocus some of their climate goals. So, in conclusion, this has been a particularly turbulent start to the year. Not only have we seen a change of administration, we've seen natural disasters, we've also seen aviation disasters, as well as quite a hard line approach and big bang approach to new policies being initiated by the Trump administration. This has given markets quite a bit to contend with. There's been a lot of digestion and some indigestion of some of this news. We see divergent economies, we see divergent central bank approaches, and now we have to throw a modeling of quite abstract tariff consequences into the mix. The law of unintended consequences, which we're always trying to focus on, is throwing up already some interesting twists. We've seen a resurgence of pro-Canada nationalism as the neighbor, great trading partner of the US was quite taken aback by the suddenness of the tariffs and not quite clear what it was expected to do in response to that. So that seems to have stirred up a pro-Canada, buy Canada impulse on behalf of Canadian consumers. That perhaps was an unintended consequence. We also know that retaliatory tariffs are now being anticipated by these partners. So that again, something that perhaps was not modeled out because for the most part, it was expected that the Trump administration would not go down the route that would upset markets. Markets resilience, again, seems to have been, for now, holding it together, but we don't know for how much longer. And just to touch on what this means for other asset classes, I would say at this stage, this is really bringing into focus the volatility that perhaps is yet to come within the equity market. We have known for some time that it's been fixed income where the markets have shown more volatility of late, and that's likely to continue because we've seen certainly changing in expectations around the state of the economy. And certainly if there was a big tariff shock, that would likely very much change the outcome for the economy, which could then lead to more volatility in interest rate expectations. So when it comes to equity markets too, based on some of the wild swings and overreaction or punishing reactions that we've seen across not just main sectors such as tech, but adjacent sectors, we would expect an uptick in equity market volatility too. And what does this translate into? This, I believe, improves the relative attractiveness of private assets today. Private assets, many of them, of course, are not marked to market. There is also a contractual underpinning to many private markets returns. For example, in private credit, or in real estate, we'd be looking, or also in infrastructure, we'd be looking at rents, toll payments, for example, or in case of private credit, contractually bound interest payments. So all of these things sit apart from market movements and market volatility, even though at some level the ability of a tenant to pay rent or the ability of a borrower to pay back its loan will be affected by its fortunes. This is not going to be timed in the same way, nor of the same magnitude as we would see in equity market corrections. So again, this does highlight why having divergent sources of return in a portfolio, as well as divergent time horizons, is essential to see that portfolio behave as an all-weather portfolio. I would say the public side, which has been responsible for the lion's share of returns up to now, has perhaps borne a disproportionate amount of the risk. Now I would see that looking like it could change in that we may see return of the equity market volatility to closer to norms. And whereas we're likely to see private markets continue to perform quite well, if we just look at how the private market titans are aligning themselves with the new US administration, they are clearly doing that as they believe that the regulatory change and tailwinds will inure to their favor. Certainly tax cuts and treatment of carried interest, etc., all of this, as well as a less regulated environment overall, could inure to the favor of private markets. We still have not seen the pickup in the IPO market that we thought was likely, but with this arms race we mentioned before, and flush cash rich and flush corporate actors, this could very much improve the environment for M&A for private market actors. So I'd say overall good fundamentals for private investments at this point. And I would say across the portfolio, this segment of portfolios are likely to look relatively more attractive. So that is our digest from this week. Look forward to joining you next week. And thank you very much for tuning in to the Markets Happy Hour podcast.